Well, good afternoon. Welcome everybody to this macroeconomics and trends, macroeconomic trends and the future of investment panel that is organized by the Association of Pension Funds Administrators in Mexico. My name is Edgar Díaz. I'm the CEO of Pensionissste, which is the only pension funds, public pension funds in Mexico. I would like to thank you for being here, and I will introduce you to our three panelists that are going to be with us today. First, we have Asawari Sathe. She's an economist from Vanguard Strategic Investment Strategic Group. She has an interest in research about trends in emerging and labor markets. She's also interested in monetary and fiscal policy, and she also likes to know about the effects that technology has on the world economy, among other topics. Before Asawari joined Vanguard, she was an assistant process manager at eClerx. She graduated in economics from Symbiosis International University, has a master's degree in financial economics from GIPE Institute in India, and a master in economics from the University of Wisconsin-Madison. Joining us also is José María Sosa del Valle from Lexington Partners. He leads the firm's activity throughout the Latin American region and is responsible for managing the Santiago, Chile office. He is primarily involved in the generation and evolution of non-US private equity secondary buyouts, the generation and evaluation of direct co-investment opportunities in Latin America and in the region. Prior to joining Lexington in 2008, Jose worked as a Goldman Sachs investment bank as an associate, and he graduated from the Instituto Tecnológico de Buenos Aires and holds an MSc in Industry Engineering and an MBA from Columbia University Graduate School of Business. Also joining us today is Sebastian Schiele. He works at Asia Pacific at WS, is responsible for building passive investment solutions for and with asset owners. His expertise ranges from traditional and smart beta to ESG integration and passive portfolios. He joined the team in 2009 with a background in banking, consulting, and asset management. Holds a Master of Science from the Frankfurt School of Finance and a management certified in the EFFAS, and is also certified as an ESG analyst. Welcome you today to this panel. I would like to start just by saying something to open the conversation with you. The world economy has been living some difficulties, as you know. The pandemic hasn't ended, but all around the world, the vaccination process has given us, to all of us, some good news, and the economy is recovering, maybe not in the same way in all the countries, but we are seeing a recovery in the world. Also, I think that some of the policies that the policies that we need to choose now to improve the global economy, we are facing a multidimensional challenge. I think slow employment growth, rising inflation, that now seems to me more permanent than transitory that some of us have thought before, and food security and climate change are the main challenges that we are facing today. And in that sense, I think that as we are rebuilding our economy following the COVID crisis, I believe pension funds could play a significant role in stimulating new industries and in funding much needed long-term investments in infrastructure, housing, new technologies, and also helping address climate change. In that sense, what will be the future of investments and the role of pension funds that you are expecting for the world economy to see in the near future, but also in the longer term, let's say 30 years from now? So I don't know who wants to start. So I think we can start with Asawari.
Thanks, Edgar. Thank you for having me here today, and thank you for the generous introduction. Looking forward to some of the discussion with our esteemed co-panelists as well. As you mentioned earlier, some of these topics are top of mind for us, and as a member of the investment strategy group, I think we are uniquely placed to discuss this in the call here. Just to give everyone a brief background of what the team does, we essentially are a team of global economists and investment and portfolio strategists. We work to provide research-based thought leadership on various economic and investment topics externally, and we also work internally with our portfolio managers to talk about, what is it that's going to drive the economic and monetary policy? What are some of the other factors that could have an impact on some of the day-to-day portfolio decisions that the team makes? And we also interact externally with our clients in various formats, be it one-on-one client interactions or through some of our research publications, through white papers, through journal publications, and trying to bring out the Vanguard's voice in the industry. And so to talk about, how I'll be contributing to the call, it would be, as an economist, structured more about macro trends and touch upon how that impacts retirement savings going ahead. Um, we have certainly seen turbulent years, a couple of years in the past, and that is going to form a lot of the impacts we see over the next year. Certainly, we are seeing a change in the way that health outcomes are driving the conversation, but we think that macro policy and the changes we see over the next year would be key in economic growth, both across developed markets and emerging markets. One thing that's top of mind is definitely inflation, and I will be talking to you on this call about inflation and how we see that driving some of these macro policy decisions, whether it accelerates them over the next year. That's something that we are paying close attention to. Another thing that we have seen globally is this supply shock, the likes of which we have not seen outside of world wars. And that certainly has shifted the dynamics around supply chains, about some of the mega trends that we have seen, especially around globalization. So I'll talk a little bit about some of the recent research that the team has brought together about globalization. What do we see the trends there, and what is the impact on investors in general? So that was a brief introduction from my end. Edgar, passing it back to you.
Thank you, Asawari. Now, Jose Maria, could you give us your statement?
Sure. Very nice to see you all. Thank you for the invitation. Edgar, thank you for leading this panel. Lexington Partners is a global private equity firm with more than 25 years of experience. We manage circa $60 billion of capital, and we are investors today in more than 1,800 private equity funds. I run Latin America, and we have been fortunate as pension plans across Colombia, Peru, Chile, and Mexico have been investors with us over the past 12 years. We have witnessed globally the growth on the alternative investments portfolio across pension plans. And we certainly keep track of it, as it's our role to provide liquidity on the inventory that investors build on the primary front. The alternative industry has grown tremendously over the past 3 decades, and it has become an important part of the financial system, the global economy, and also of the global portfolios. The industry has grown from 5 trillion in 2008 to 12 trillion in 2021. And according to Preqin, it's poised to grow at around 10% CAGR and reach 17 trillion in 2025. There's a very good article today on the Wall Street Journal talking about pressure on cash in lieu of the high relevance of private investments in United States pension plans, and certainly shows how, as exposure to private assets grow in public pension plans portfolio, there has to be a focus on cash management and access to liquidity as retirees come to time. The alternative investments have moved from what I would call the periphery of a global investment portfolio into the mainstream over the past 15 years. The share of wallet or the share in any portfolio has grown from 6 to 12% until 3-4 years ago, and is, based on projection, expected to reach between 18 to 24% by 2025. Institutional investors like public pension plans have been critical, and they've been the driving force behind this growth. As it relates to this panel, if we look specifically into the public pension plans, and those tracked by Preqin as a data point, have steadily increased their allocation to alternatives. And by the end of 2020, their median allocation was 18%. Excuse me. By the end of 2010, the median allocation was 18%, growing to 30% by the end of 2020. This growth has generated sophistication across global institutional investors who are demanding the evolution of the asset class, improvements in reporting, transparency, ESG standards. Certainly, technological advances have helped to the delivery of these requests, and we expect to continue being the case. In summary, the alternative asset space have grown from single digits to circa 30% of any portfolio. When we look into LATAM, which is a region that has come to invest in this asset class over the past decade or so, international alternatives represents less than 10%, sort of 9% and change of any portfolio, and it's expected to grow in the near future.
Thank you, Jose Maria. Thank you for your remarks. Now we pass to Sebastian.
Fantastic. Thank you very much, Edgar. I'm delighted to be able to join you, Asawari, and Jose in today's panel. I am head of passive mandate sales for Europe and Asia Pacific. That means my team helps pension plans and other institutional clients in these regions identify and implement passive allocations, which I think is a sensible addition to today's panel, as we'll be having the economist's perspective on the one hand, the private equity perspective on the other hand. So let's try and complement this with the passive and the index-linked perspective in today's conversation. What we're really seeing as trends in the industry is there are certainly in EMEA APAC a rising interest in sustainability, something that we're seeing picked up in the Americas and particularly LATAM as well. There is secondly, and that's due to historically low rates in the market, also perspective on inflation, a view towards yield and yield-seeking strategies and ways to increase income in pension funds portfolios. And thirdly, there is quite a drive towards fee transparency and lower fees. So finding ways for pension plans to afford a strategic and systematic asset allocation in a low-cost basis that actually brings together all of those pieces: low cost, higher yields and returns to actually help returns for the pension plan, but also bring into sustainability criteria that are sometimes driven by members, sometimes driven by regulation, and sometimes driven by market forces. So it's really an interesting kind of space to be in, and complement that with the economic perspective, as well as more satellite kind of allocations, for instance, in private equity. Delighted to join the panel and bring our DWS's perspective to the conversation, which is a top 25 global asset manager, second largest ETF provider in Europe, and the largest global passive provider based in Europe. Thank you very much for having me on today's panel.
Thank you, Sebastian. I think you three have been introduced very interesting topics. We've talked now about how inflation will drive macroeconomic decisions and how this will impact the investment process or the investment decisions. I think You have also pointed the importance of ESG standards. And as you have said, lastly, we have also looking to see in the future how investment could have lower cost and higher yields. So I think now we are going to pass to more specific questions that will help everybody here that's in this panel to understand a little bit more about the future of the investments. So I would like to start with Asawari with one specific questions. I think that you could help us with this. What are the main macro trends that global asset managers are studying currently that may change the economy in the future?
Thank you, Edgar. That's certainly a question that's been top of mind for us this year, particular. I mean, every year, but more so this year, just given the landscape you're seeing around us. So as we look into this year, let's sort of think about two set of drivers that the portfolio manager or asset managers would be paying attention to: the more near term or the cyclical factors that we look at, and the more longer term or structural drivers that influence growth impact on in a much more longer term trend. Now, when we think about near term, we are sort of looking at macro policy and the shift in macro policy that we expect going into next year. So most of the pandemic impact, or we have seen throughout the pandemic that macro policy has taken center stage. Both monetary and fiscal policy has become extremely accommodative. You have seen stimulus trying to support economic growth, trying to build up some of the disposable incomes with consumers, while with monetary policy, you have seen extraordinary accommodation across both developed markets and developing markets as well. Now, moving into next year, some of that is going to shift gears into moving towards less accommodative and then finally towards rate hikes. Across developed markets, we expect that shift in policy stance to begin as soon as the second half of next year, if not by later next year as well. So we might start seeing rate hikes from central banks, Bank of England, the Federal Reserve, as well as from ECB as we start moving further down from next year to 2023. Now, that is going to be a key factor, especially because policymakers are sort of struggling between how to change policy stance while still supporting the fragile economic recovery we are seeing right now. So if we look into next year, for across most economies in the developed markets, we are seeing above trend growth rate. Across emerging markets, we are seeing growth that is sort of recovering back, but still staggering because of the COVID and the health implications that continue to plague some of these places. But generally speaking, we are seeing a waning relationship between health outcomes and economic impacts. And that's certainly driven by the severity of cases falling down. So you are seeing a decoupling in health cases or severe health outcomes, and that's sort of lowering the impact of the COVID virus on economic impacts themselves. And so near term macro policy, health impacts waning is going to be top of mind. But the third factor that's going to drive the policy stance is inflation itself. And that sort of brings me to some of the discussion on inflation, which I'm sure we'll revisit later as well, is that we are going through this almost global supply shock that's having an impact on supply chains across the world. While at the same time, you're seeing this fiscal impulse driven demand across the world, which means you're increasingly coming up against higher demand than potential with supply which is much lower than potential. And that's driving some of this inflationary impact you're seeing across the world. Now, we expect globally inflation to be quite high even next year and staying somewhat above central bank targets as we move into next year as well. However, this brings us back to the transitory versus permanent question that you asked Edgar earlier in the discussion. It certainly takes away from the transitory component, seeing that you are seeing high inflation for 2 years almost. But over the longer horizon, we do expect inflation to start to get back to central bank targets, especially for the US. We expect inflation getting back to 2% by 2023. Now let's shift gears and talk about the structural drivers here. And when we talk about structural, we essentially think about mega trends or trends that have been driving economic growth over the last couple of decades. So the big three trends that stand out there are demographics, technology, and globalization. Um, Now, when we think about demographics, that's basically this almost inexorable move towards an aging population. So we are seeing aging populations across not just developed markets, but across emerging markets as well. The other factor that we're seeing is that there is a shift in the trend of globalization. So more recently, a paper published by the team on deglobalization talked about this speculation that, hey, supply chains are essentially breaking down, and we are seeing a fall in global trade volumes. And that was the speculation that we essentially wanted to look a little bit deeper into. We reach a slightly different conclusion from the consensus in general. We do see globalization or a slowing in global trade growth, but we don't see that falling into negative. One of the questions that's come up with the pandemic is, oh, just because of all these supply shocks, companies or MNCs are realizing the shortages of supply chains, and you will see reshoring of activities. We think that that's slightly over exaggerated. You might see some reshoring, you might see some strategic reshoring, but you would not see a full reversal in supply chains, especially because they are so well ingrained in the global economy at this point of time. What you might see is slowing down of global trade, generally speaking. And if you really look back at the data, that's not a new trend. That has been in place since the GFC. We have seen global trade volumes falling since the global financial crisis. And that's largely because the lower hanging fruit of expanding trade has been taken. And you are now seeing a normalization in global trade, generally speaking. What this means is, from a global economic growth perspective, that you might see higher impact in economies that have a higher trade impact. So countries like China, say Australia, say Brazil, you might see higher impact on economic growth as global trade volumes generally, the growth of that begins to fall. But across EU, across US, you might not see as much of an impact given what share trade is as a percentage of total GDP there. So deglobalization, we think, is largely an exaggerated outlook here. Globalization, certainly a possibility and something that we are seeing. And sort of, in summary, if we think about both near-term and longer-term, factors that asset managers are going to pay attention to, it's macro policy driven by high inflation that we expect to persist over the next year, as well as some of these longer term drivers of deglobalization or of globalization, as well as demographics that would drive the longer term real interest rates that we're seeing across the world. So with that, Edgar, I'll pass it back to you.
Thank you, Asawari. So certainly you have mentioned very important things about how we are experiencing a very complex recovery all around the world. And in that sense, I think that pension funds could make a very important role in this recovery. And coming back to Jose Maria Sosa, I would like to ask you, in your experience, how the alternative assets can make a difference in the pension fund. I don't know if you could elaborate a little bit more about how these alternative assets has been growing in the pension funds portfolios, and how do you see in the future? What do you expect of these kind of assets in the future?
Sure. Thank you, Edgar. As I said at the beginning, the alternatives have become a very important part of any global portfolio, and certainly entail and have an impact on real economies. Pension plans across the region have invested substantially on domestic private equity, fostering and financing real economy businesses that, particularly in some regions, tend to have limited access to credit, and they need credit and capital to continue growing. In Latin America, as I said, alternatives represent circa 9% of the portfolios. These varies across the region, and the breakdown between domestic and international varies too. You can find some examples where alternatives can be closer to 20%, or you can find also some cases where it's 5%. As these allocations grow, where pension plans are seeking for yield at the expense of liquidity, something that typically you could achieve in bonds a few decades ago, potentially. These pension plan managers need to be more mindful of how they're going to manage these asset class as it grows in size within their portfolio. And that's how a secondary market has developed over the past 25, 30 years. The inventory of primary capital stands at around $5 trillion today. That's what the secondary market tends to trade on. The rate of adoption, which means the share of the primary capital that trades on the secondary capital, has tripled over the past 10 years. It has gone from 3.5% to almost 12%, meaning that 12 cents of every dollar raised on the primary alternative asset space trades on the secondary market over the life of the fund. That has given rise to a secondary private equity market that 2021 will reach $100 billion. And it was only $20 billion 8-9 years ago. So the secondary market provides a liquidity alternative for a growing primary alternative asset class. We foresee a continuous growth on both primary and secondary space. Investors foresee the same thing, and I think they're funding managers around the globe tapping on these opportunities.
Thank you, Jose Maria. Thank you for your comments. So now let's pass to Sebastian. Sebastian, could you tell us what are the biggest challenges that pension funds are facing right now, or telling us a little bit more about how the current challenges are shaping the future of investment?
Right, very happy to. And as I was already alluding to in our introductory kind of conversation, really the big trends and the big pressures the pension funds currently are seeing, and specifically using Europe as an example, is really around lower fee because of fee transparency and fee pressure, which basically leads to passivization. It's not a European phenomenon, it's a global phenomenon. If you look at Australia, for instance, there are two specific regulations. On the one hand, pressing for more transparency on the fees that pension funds actually pay to their service providers. But on the other hand, regulation that is called Your Super, Your Future, effectively creating new tax-adjusted benchmarks to compare pension funds against, that effectively removes the tax advantage, the withholding tax advantage a pension fund may see in the equity space from performance comparability calculations. So transparency is certainly a global trend that we're seeing, which automatically leads to more passivization as fee transparency leads to lower fees. That's an important trend. That, as a secondary effect, leads to what we like to call active allocation with passive building blocks. So the strategic asset allocation of pension funds effectively now is typically more shaped around a long-term passive core allocation for which you may want to use satellite building blocks from other asset classes there as well. And if you begin to think about it, intuitively makes sense that in certain markets, you simply cannot gain an edge anymore as an active allocator. If you look at US large cap equities, for instance, or US treasuries, an active strategy simply cannot gain any sort of advantage. So clients would like to use a passive allocation and then for those kinds of markets, and then use higher fee budget for other kind of satellite allocations. We as DWS, we're a top 25 global asset manager with a strong footprint in active, in passive and alternative allocations. So really are able to help facilitate those both core and the satellite allocations. So really see our clients shifting from their original kind of allocations to this passive core and then using more alternative or active strategies in the satellite exposures, if you will. And the third trend really is sustainability. but that really depends on client domiciles, because depending on where pension plans reside, they may have increasing pressure from the regulatory side to include such sustainability criteria in their asset allocation, in the way they build and maintain portfolios. In other markets, it's simply client and member awareness that sort of instigate that trends towards increased sustainability. So there is no homogeneous kind of approach. Not every pension fund in every region, in every market has the same objective, has the same speed, has the same awareness of how they should implement sustainability. But what I can conclude that it certainly is an emerging force. More and more pension plans now want to include sustainability criteria in their long-term asset allocation objectives as well.
Thanks, Sebastian. I would like to stick with you with these last questions, because you have been talking about how clients are shifting their decisions. So I don't know, you could elaborate a little bit more. Is this strategy coherent in the clients, or is just relevant for the portfolio, or is it more like an engagement of the pension funds or the clients just to go towards ESG portfolios, or to a more oriented ESG portfolio?
Well, I think there are three sort of topics in that question one could touch on. The first is, are there sort of coherent strategy? Not generally, other than on the climate front. Maybe because of COP26 and the increasing number of clients and companies in the market committing to net zero targets, decarbonization, low carbon and Paris aligned kind of asset allocations certainly are a common theme that we are seeing. So more and more clients wanting to discuss ways how to decarbonize their portfolios, their overall asset allocation, and set their portfolios on a path to net zero by latest 2050, if you will. So that's certainly one common thread. But then secondly, more generally on ESG objectives, it's a bit more dispersed. And again, that really depends on the market and how far advanced clients and the respective markets in their sustainability journey, if you will. For instance, SDGs are a key theme to look at if you discuss pension plans in the Nordics or in the Netherlands, because they are very far advanced in their sustainability journey already. Other markets are really to begin exclusion criteria in their ESG and in their broader allocations, if you will. So really, some are taking the early steps towards including ESG. Others are very far advanced in their journey already. So from a general ESG kind of perspective, there certainly is no coherent kind of theme, if you will. Can be pure exclusions as a starting point, can be more advanced strategies like including the UN Sustainability Development Goals, if you will. What certainly has helped is the emergence of more consistent frameworks, the EU taxonomy, for instance, on what actually constitutes sustainable activities, with a focus on environment to begin with, but now with the social pillar as a next kind of framework to look at. Gives you a view as to how sustainability can be implemented in portfolio, and with those emerging frameworks, clients are now looking to implement that within their asset allocation as well. And the third bit that you spoke of is engagement, which certainly is becoming a very, very relevant tool to steer ESG in broad portfolios, not just in sustainability-driven portfolios, but portfolios in general, if you will. So clients really realize that engagement is a key factor to actually round up a holistic implementation within portfolio context, if you will. So both looking towards engaging with the companies, as in engaging with them on a regular basis, give them certain targets, how clients want to see those companies improve on their ways, and actually follow up on a regular basis, as well as on the proxy voting side of things. Proxy voting as in how votes are submitted. Proxy votes need to be submitted on a regular basis, and also how those votes are submitted in line with the broader sustainability agenda, if you will. So years ago, clients really didn't have that on their radar to form part of their own sustainability activities, but also as a criterion to select their asset managers, while now this is very much on top of mind. So we've been doing some really interesting studies together with Create Research, beginning in 2018 as a view on how passive shapes the overall institutional landscape. And then beginning on the ESG trajectory in 2019, the 2021 strategy effectively looked at the social pillar, if you will. And we've been interviewing 140 pension plans globally across 17 jurisdictions with the help of IPE to get a breadth of perspective, if you will. And then follow up with 40 detailed pension plan interviews to give more depth to those perspectives as well. And one key takeaway from those pension plans responses on selecting partners for their sustainable agenda was really deliver track record, deliver understanding of our objectives, of our sustainability goals. So demonstrate that you're able to have the capacity, the track record, the understanding to implement those, but then also have the proxy voting and the engagement track record aligned with our targets. So clients really realize that this is actually much more important than fee these days. It's quite an interesting take, if you will, but those are the three kind of takeaways that we have. On the one hand, if there is one consistent goal, it's around lower carbon decarbonization. Second, there are no homogeneous ESG targets, if you will, but really there are different speeds across the various markets. And then thirdly, engagement and proxy voting certainly is a common thread because clients realize this is becoming much more important as part of holistic strategy.
Thank you very much, Sebastian. Very important information that you are giving us today. I would like to come back briefly with Jose Maria, because this panel is organized here in Mexico for all the sector that is called here Afore. And as you have mentioned, alternative assets have been taking more and more importance in the portfolio construction. So what would be your advice for us in Mexico? Because you have been in this path long before us. So what would be your advice for us that are now in charge of managing this kind of projects? Because you have said very important things that it's traded more in alternative assets in the secondary market. So what would be your advice for us?
Well, I'll say, well, yes, it's been great to deal with the Afores in Mexico. We enjoy the sponsorship of 5 of the Afores in our latest fund. And I've personally been very close to the diligence process. We've been very positively surprised with the knowledge and the experience of the teams, of the in-house teams that are performing diligence and selecting the managers. And that's the first advice. Dedicate resources to build knowledgeable teams. Alternatives are a very specific industry type, is a specific industry type, and developing professionals with the knowledge, the experience, and the understanding to read through the different offerings, navigate diligences, both domestic and international, is something that is critical. And as it is a relatively new asset class for some of your pension plans in Mexico. That's advice 1. Advice number 2 is maybe do a leapfrog jump and avoid making mistakes that were committed across other parts. Understanding that at the beginning there is less conviction. Nonetheless, I would focus on developing core relationships where the Afores can lever in order to achieve and obtain knowledge, best practices that are easily portable to the Afores in order to understand industry trends, to understand tools to select and perform diligence that have been around and have been improved globally for the past 30 years. A relationship with the GP extends beyond the actual simple returns or private partnership. And if you stick and concentrate to some some good partners, you can leverage that relationship. And finally, diversification. When it comes to selecting the different asset classes, make sure that as you invest through vintages, you are well diversified through vintages, through managers, through sectors, and through industries.
Thank you very much, Jose Maria, for your advice. We were looking forward to make close this relationship for us that we work now in the pension system. Now, I would like to pass to Asawari with one last question. You have mentioned it before that inflation is going to be a problem, but it will have an impact, but the impact will be different among countries. Can you tell us more about your perspective of the evolution of large economies such as US and China?
Sure. So, Edgar, getting back to the question on inflation, when we think about US and China, we are certainly seeing different dynamics play out for these economies. And that's driven a bit by the kind of stimulus we have seen playing through these economies in general. So for the US, over the next course of next year, we expect growth to average around 4 to 5%. That's still significantly above trend, but slightly normalizing after the growth we are seeing this year. And at the same time, we expect inflation to be above 2% for most of next year. So to give you certain projection for core CPI, expectations are to be above closer to 3% for the most of next year as well. The reason for that is you have seen extraordinary stimulus in the US. Demand has been quite higher. But at the same time, supply normalization in the US has its own unique problems. I think more recently, you must have heard the news of port congestion in the US. So more specifically looking at ports in Los Angeles and Long Beach, they provide about 40% of inbound import for the US, and we have seen congestion there, which is expected to normalize, take a couple of months or so. Moreover, you are also seeing a sort of, reduced capacity in warehousing. You are seeing smaller inventories built back than you would generally expect around this time, which means that supply has a long path ahead towards normalization, while at the same time, demand is continuing to remain strong, especially as we head into the holiday season, which means that for the US, you're going to see high inflation. Now, if you look towards China, though, we are seeing a different outlook. For China, our growth expectations are that it averages between 7 to 8% this year. And as we go into next year, normalizes and falls between 5 to 6%. And that's slightly bearish as compared to consensus. And that's driven by the factors like decarbonization of the economy and the fact that we are seeing real estate changes in regulations related to that. So what's that driven is it's driven a downturn in both energy and property or real estate sectors for the economy, which has some challenges for China growth as we go into next year. One of the unique challenges for China is it is facing a much more rapidly aging population into next year, and it's also facing lower productivity than what is considered usual in this time of in this stage of the economic growth for China. One of the reasons behind that is the state-owned enterprises or SOEs that are generally less productive than its new economy or some of the IT and technology sectors. That's going to significantly reduce the productive capacity of Chinese economy going ahead, which means that it reduces, the chances of the Chinese economy overtaking US as we go ahead. So continuing along with the story, we are going to see US-China trade tensions persist even beyond the pandemic. So beginning in 2019, we began to see those. We're still seeing that with the recent talks between Biden and Xi, where they still discussed, in a very, more superficial talks on what could possibly be done, more power dynamics, but we aren't seeing any real sort of giveaway in terms of removing some of the economic protections they have for each of these sectors, which means that you would continue to see this competition and this sort of trade negotiations persist over the next 2 years. So US-China trade tensions still expected to continue. This would bode well across different emerging markets because you could see, export growth sort of move away from the EM Asia or China region into other regions as well, which means that would bode well for other emerging countries across the region. But certainly something that's yet to play out completely ahead of us.
Thank you very much, Asawari. We are running out of time, so just to give you all a chance to make a final remark, I will give you 1 minute. So let's start with Jose. Jose Sosa, can you give us your final comments in this panel?
Sure. Personally, it's been very interesting to observe the alternative space growing over the past 15, 20 years as part of the not only of the real economy but also as part of an asset class. Latin American pension plans have been very critical, and they continue to be a growing source of capital for alternatives around the world. And now Mexico is becoming one of the, if not the most relevant source of capital from Latin America for these asset class. I'm very pleased to see that the Afores are well prepared to start or continue the journey. And I think it is a challenging but very thriving path to continue growing a portfolio of alternatives for the Afores. So very excited to see them doing that.
Sorry, I was on mute. Thank you, Jose. Now, Sebastian, can you give us your final comment?
Absolutely. As hopefully was able to illustrate today, passive is an extremely relevant part of pension funds allocation. Passive is extremely flexible, it's low cost, but it's also more and more becoming a customized exposure for individual pension funds needs. We have a dedicated team servicing LATAM, servicing Mexico. We're delighted to work with the Afores to discuss your specific needs and your asset allocation, figure out how to build bespoke passive portfolios in line with your asset allocation and your market needs. I'm very much looking forward to continuing the dialogue beyond the forum today. Thank you very much.
Thank you, Sebastian. Asawari, can you give us your final comment, please?
Thank you, Edgar. And, drawing from some of the similar conclusions we have come to, we are definitely seeing some concerns, inflation as being one of them, more near term for investment. And as, looking for how to save or how to invest for retirement specifically, we think of inflation as much of a near-term issue, which realistically, if you think about the longer term or the longer term horizon we are looking for retirement savings in general, doesn't really amount to much of a change. We would still expect investors to be focused in on their risks in the near term as well as over the longer term, and think about portfolio allocations within that sense. When we talk with our portfolio managers about some of the concerns, and we talk about clients as well, they're more focused on what are their specific needs and asks over the near term and long term. And when we think about the economic environment, it's more about investment in general, and investment and protection against inflation in general. And we think that there are some ways to customize the portfolio and provide more of a ballast to your returns going ahead. Realistically, we are sort of moving towards lower interest rates environment, which sort of limits the outlook there, but there are definitely opportunity areas that we see going ahead as well. Thanks, Edgar.
Thank you, Asawari. Thank you all you three for being here with us. I think it's been a very important conversation. We have talked about different topics that we've been setting from the macroeconomic perspective and how the different instruments or different strategies are going to help to reshape the economic growth in the world and among our economies. I would like to see you all further. The time is short, so now we have to end this. But I think everybody that is listening to and watching to this will have very good ideas and very good topics to keep elaborating, to have a better knowledge, and to think about the future of investment in the pension funds. So thank you, you three. Thank you to Amafore for organizing this, and it's been a great thing for me coordinating this panel. Thank you very much.